For years, growing the GDP had been Beijing's #1 economic priority. It has relied on borrowing money to grow the GDP. But the problem is that its debt has grown faster than the GDP has. From 2002 to 2020, China's GDP grew 8.8 times, while its debt grew 20 times. Every dollar that China borrowed failed to contribute to the GDP by the same amount. China's debt is now 3 times its GDP. Evergrande's insolvency crisis has reignited people's concerns over the country's debt problems. Is China able to pay back the massive debt it owes? Hello, welcome to my show. I'm Lei. According to Paul Hodges at Independent Commodity Intelligence Services, from 2002 to 2020, each dollar of debt China took out created only between 41 cents to 45 cents growth. So the value created by each dollar is less than half the cost of the debt created. That's why Beijing must keep borrowing to meet its GDP goal. And now it is borrowing more from foreign investors. Only a few years ago, economists dismissed worries over the size of China's debts. Former Fed Chairman Ben Bernanke said in 2016 that the debt pile facing China is an internal problem, given the majority of the borrowings was issued in local currency. In the past several years, however, a record amount of foreign capital flowed into China's bond market and its foreign debt grew exponentially. From 2002 to 2020, China's full caliber foreign debt grew 12 times, which was faster than the GDP growth of 8.8 times during the same period. It was $2.7 trillion at the end of 2021. Its non-Chinese currency portion includes loans from foreign banks, trade-related credit from foreign trading partners, and debt securities issued by Chinese firms to foreign investors. By comparing data in the past several years, we found several trends worth noting. China's foreign debt is issued by its government, central bank, commercial banks, and non-financial enterprises. If we compare the percentage of total debt in these 4 categories between 2014 and 2021, we can see that debts issued by commercial banks and non-financial enterprises were reduced from 91% to 79%, while government debts increased from 6% to 18%. That means foreign investors are financing more Chinese government activities. This doesn't mean that Beijing doesn't benefit from the debt issued by the commercial banks and enterprises. Because large commercial banks and conglomerates are state-owned, the Chinese government may indirectly control and benefit from the corporate foreign debts. During the pandemic, Wall Street played an important role in helping foreign capital flow into China's bond market. As of last October, China's government bonds were included in all 3 major global bond indexes: the FTSE Government Bond Index, Bloomberg Barclays Global Aggregate Index, and JP Morgan's Government Bond Index. This helped China's debt securities double from 16% in 2016 to 32% at the end of 2021. And the growth in debt securities accounted for 50% of the growth in total foreign debt over the past 5 years. According to a People's Daily article from April the 5th, the inclusion of Chinese bonds in the major indexes will bring $250 billion to $300 billion capital to China and significantly stabilizes the size and structure of China's foreign debt. Another trend is that international investors have been steadily increasing their holdings of bonds in renminbi. The proportion of foreign debt in renminbi increased from 34% in 2016 to 45% at the end of last year, and the market value of renminbi bonds held by international investors was 5.6 times higher than the amount 5 years ago. The People's Daily quoted a person at China's Foreign Exchange Bureau saying that 50% of the renminbi bonds are held by foreign central banks with long-term allocations, which benefits Beijing's goal of globalizing renminbi. In addition, The proportion of medium and long-term foreign debt increased from 39% to 47% in 5 years. The increase in longer-term debt reduces China's liquidity risk. Now let's take a look at China's ability to pay back its foreign debt, which is the money it borrowed from non-Chinese nationals. To do that, we must take a look at its foreign reserves. I think it may not be sufficient to pay the debt. You might say that's nonsense, since China has the world's largest foreign reserve, currently at $3.2 trillion. It's over 2.5 times more than the second largest reserve holder, Japan, which has $1.2 trillion. But unlike Japan and other countries, the Chinese regime controls not only the government reserves, but also all foreign currencies in its private sector, and that's why the foreign reserve seems high. Chinese citizens and private businesses cannot hold foreign currencies or make foreign currency transactions without government approval. I made a video about China's foreign reserve policy. You can check it out at the end. Because of this policy, domestic and foreign companies investing in China cannot use foreign currency to settle their debts, but must deposit foreign money in Chinese banks and exchange it for renminbi. When companies need to make external bond payments, they must take foreign currency from the foreign reserves to pay for them. Which brings us to the question of whether China has enough money in its foreign reserves to pay for the debt. Let's take a look at what China's foreign reserves should cover. The first on the list is the foreign investments in China. According to the State Administration of Foreign Exchange, foreign direct investment in China reached $3.36 trillion in 2021. This means that if all foreign investors decide to withdraw their investments, it will zero out China's foreign reserve currently at $3.2 trillion. It's unlikely that all investors would withdraw from China, but with the current geopolitical situation and the grand capital exodus we saw in March, let's set aside 30% of the total investment and assume 30% may exit China. That's $1 trillion taken out from the $3.2 trillion reserves. We have $2.2 trillion left. China will spend roughly $500 billion in 2022 on imports of oil, natural gas, metals, food, raw materials, and so on. If we deduct that amount, we have $1.7 trillion left. That's not enough to pay for the $2.7 trillion foreign debt, and it's just enough to pay for the $1.5 trillion short-term debt, which is mostly debt from Chinese commercial banks and non-financial enterprises. And we haven't factored in the foreign currencies that Chinese households require for travel and overseas expenditures. Beijing knows it's short on foreign reserves. To limit private citizens' use, the CCP has set an annual $50,000 limit per person for foreign currency transaction. Taiwan economist Wu Jialong did the same calculation last year and concluded that China's foreign exchange reserves were not sufficient to pay for its debt. He predicted that renminbi would depreciate, which we've already seen happening. Local government debt, household debt, and foreign debt are the three fastest growing debts for China. We only discussed the foreign debt today. We'll talk about the other two some other time. Here's the video I made to explain how China obtained extra funding by controlling its private citizens' access to foreign currency. That's all for today. Thank you for watching, and I'll see you soon.